much for joining us today for one of our weekly webinars here at the Retirement Group. My name is Sam and I'm in Client Services. I moderate these weekly webinars for you. In just a minute, we're going to be joined by one of our senior advisors. His name is Patrick Ray, and he will be going over some topics related to the upcoming election and how it relates to value investing and some other things, of course. But before Patrick comes on, I'd like to very quickly remind you, although we work very closely with both active and retired clients of Boeing, the Retirement Group is not affiliated nor endorsed whatsoever by Boeing. We are a completely independent group of financial advisors. Please keep that in mind. After Patrick's presentation, I will rejoin him very quickly to ask him some of the questions that were entered into the Q&A chat throughout the presentation. We always try to do our best to answer as many questions as possible, time permitted, of course. And throughout this presentation, you may see some YouTube cards popping up on your screen as you watch. They will guide you to our complimentary cash flow analysis, where you can get started on your retirement planning with an advisor, as well as other videos, past videos that may be of interest or concern to you. So please click on those and take advantage. And with all of that out of the way now, let's bring on our speaker, Patrick Ray. Hey, Patrick.
Good afternoon, everyone. Thank you very much, Sam. Hopefully everyone's having a great day. Thank you for joining us today. And today we've got an important topic to cover, which obviously comes up for us on a regular basis about every 4 years or so, which is how to adjust or potentially adjust, or how to think in terms of what to do, if anything, when we have an election and how it may impact your overall portfolio. And so just a couple of reminders of what we're talking about in the grand scheme or big picture of things. When you have an environment where we have a ton of government spending, and ultimately long term that typically yields or equals a higher tax rate environment. And so, but to get to higher government spendings, you have inflation. And so we've seen over the last 18 to 24 months, inflation has took off significantly, certainly more so than it had been in the last 5 to 10 years or so, right? And so when you have inflation, it correlates to higher interest rates. And often when you have higher interest rates, it's a great time to talk about what potential opportunities that we have, because often when you have a higher interest rate environment, a lot of the discussion is the doom and gloom and how to allocate your money to fixed income related things, because you're finally getting some decent rates of return on your CDs that you haven't seen in over a decade in some cases. And so there's a lot to that, right? So what we want to talk about today is a couple of things: how to capitalize on what is an effective market slowdown. And so if you have an impact between higher government spending and these higher inflation rates and ultimately higher interest rates, what it means to the general economy, because there's a lot of talk about some potential recessions coming, or certainly market slowdowns in whole. And so our philosophy when this comes up is to stick to, or to think in terms of, value-based investing. So we're going to talk about that today. And we're going to talk specifically about what that is in comparison to the growth world, because often when you see or read anything in the news about what's going on in the markets, it's typically correlated to the growth sector. And that's the fancy and flashy way to talk about higher earnings ratios and higher multiples, and ultimately what they talk about as far as expensive stocks. And so we want to talk about our philosophy specifically and how we may combat an environment where the markets are slowing down, and ultimately this may be a risk for you when you're leading into and getting into retirement. So under the value-based philosophy, what we're trying to do in generalization is to buy solid companies below their intrinsic value. And typically this means that they have low price to book ratios. These stocks have low price to earnings ratios. Most of them pay a dividend. Some of them pay higher than average dividends. And this is a way for us to identify what is a great money manager, because if they have these philosophies built in place, we know historically that the value-based sector has outperformed the growth sector. In fact, I'm going to read you a quote here shortly about what somebody that's very, very successful in managing retirement assets, or assets in general, has said about the difference between value and growth. And so when we instruct our capital in your retirement portfolios to get to the value-based sector, we're accomplishing a couple of things. One of the biggest is avoiding permanent loss of capital. And while this may sound rudimentary, the reality is the average person does a very poor job at this particular thing, which is to help ensure that you build in something called a margin of safety. And so when you buy value-based stocks that are trading below their intrinsic value and below their price to book earnings and below price to earnings ratios. What this means to you is we're identifying a margin of safety so that when the markets go down, you have a softer landing, so to speak, right? It doesn't mean your accounts aren't going to ever go down, because that's impossible to have happen unless you just don't put your money in the stock market. But if you have participation in the market and you use a value-based investment philosophy, identifying a margin of safety is a way for you to help keep from these large EKG looking charts over time, certainly during your retirement. And what it allows us to do is reduce our downside risk. And so what this looks like in a graph format is, this is a comparison of the Russell 1000 Value Total Return Index and the Russell 1000 Growth Total Return Index. And this goes back pre 1985, right? So this is almost 40 years of data. And you can see that starting in the mid to early 90s, these things were correlated pretty well. They traded very close to one another. And there was a few years where value outperformed growth, and then growth outperformed value. And then you have this downturn. But what's unique about what I want to point out here is, during this downturn in the mid 2000s leading up to 2005 and 2006, is you can see the purple line, which represents the difference between, the purple line represents the value index, and the growth is represented by this orange index, and the spread between how your portfolio would have went down on the value side versus the growth side. And the reason this is important is because it takes an exponentially greater return for your growth portfolio to get back to square one when you lose a exponentially bigger amount of money when the markets go down. And so in this case, this is close to 6%. In this case, this spread is close to 20%. And so over time, this ultimately ekes out to see, or as you can see, that value in this 40-year window basically has outperformed growth. And I had mentioned a very successful money manager that has a really interesting quote. Charlie Babrinskoy is a aerial investment manager that has been around for a very long time, and had recently stated that if you go back to 1926, value has outperformed growth in every 10-year window except the most recent 10 years. So what we do when we talk about market results, and certainly leading into what is the biggest topic in 2024, is what happens in the election environment. And so we put together a unique slide here of each election year, who the president was that got elected, what happened 12 months prior to the president being elected, what happened 12 months after the election date, and in the last column is the calendar return on a year-end basis, on an annual basis, for the S&P 500. And what's unique about this is, irrespective of what happened both before and after the president got elected, irrespective of what party was in office, that you see that you have fairly positive results for every single tax year except for three of them, or every single election year except for three of them, right? 1992, 2000, and 2008, which was a very poor year. And so what's unique about this is, we get asked on a exponentially high level with respect to how often this comes up in conversations with our clients as to what to do with their portfolios when they're entering into an election year. And I think what you find over time is, we need to have a plan. And in order to implement what might be a potential change that might make some sense for you and your family, is to ensure that that plan is not relevant any longer. In other words, if prior to the election year, we had a plan that was consistent with your tolerance for risk, your investment goals, your financial objectives, your need for income, your time horizons, and a multitude of other things, that if those things were accurate and they had not changed, it really doesn't matter if there's an election year coming or not, because unless some of these bigger, more important bullet points have changed with respect to your household, it's unlikely that it makes sense to make any adjustments to your portfolio on a large scale. Now, that doesn't mean that it doesn't make sense to potentially look at specific holdings or specific things that are inside your portfolio that may need adjustment for one reason or another. We can go back to as recent as the COVID years, when interest rates started rising. And if you had exposure to fixed income related instruments, that you would have seen a change in those values because of what interest rates were doing. And so that might have merited a reason to either remove or change where those potential investments were to address that specific issue. And so the election years and what happens to the market is really no different. And so it could potentially mean a change. And so when we have some changes, of course, some of this is correlated to how the rollover strategies work when you're considering retiring, because one of the scariest things is retirement in general. But then you add some of these variables, like if someone's considering retiring in an election year, what the retirement strategy actually looks like. And so I'll just remind you of some basic strategy with respect to how the rollover process works so that we're all on the same page. But simply, the IRS has gifted us a wonderful tool where if for some reason you have after-tax funds inside your 401k, then you're allowed to transfer 100% of those monies inside a Roth IRA. And so, of course, I don't have to tell you how valuable a Roth IRA is, but if you don't already know, a Roth IRA is where we can allow our assets inside the Roth IRA to grow tax-free for the rest of our lives. And so the more money we can earmark to go into a Roth IRA, typically the better. And so for those of you who have pre-tax monies or monies that matched from the company or came from the company that have never cycled through the tax system before, of course, we earmark those funds to go into a traditional IRA, and that basically you have two pools of money if you had after-tax money once you leave the payroll. And so this is just a refresher as to the most recent contribution and catch-up limits, where you can, based on IRS rules, get up to almost $74,000 inside your 401k, which is, by the way, surprising to some folks. So that if your plan allows you to have after-tax monies, where this spillover rule comes into play, and this means that you've put in the limits, where you've put in this 22,500 as a pre-tax limit in your catch-up limits, and you still want to put more money in, that money is going to go into your 401k after taxes. We want to get that money out of there as soon as possible and earmark it into a Roth IRA so it is productive as possible for your family and your household. And so in order to do that, we've got to have this split where you've got a traditional and a Roth IRA in the rollover and planning process when you transition into a retirement situation, obviously. And so for those of you who haven't taken advantage of the planning process that we have, to talk further about this portfolio situation and specifically the difference between what value might mean to you versus what growth might mean to you, is to have a plan. That's the reality. And so that's the thing that we think you should take advantage of, because number one, firms like ours and us specifically, we offer this service to you for free. And it's because we know that 74% of the people over the age of 50 don't have a written financial plan. And there's just no excuse for that, because we're delighted to earmark our time, if you're willing to spend some time with us, to show you that if you're looking for a partner in retirement, we may be a good fit for you. And so if the worst thing that happens is you spend some time with us and your takeaway is a free financial plan, we don't feel that as a downfall. And maybe you could recommend us to a friend or a coworker that could benefit for our services. And so we encourage you to reach out to us, and I'll give you a way to do that here in just a moment. But if you hadn't already heard of the retirement group before, we have a ton of experience on the team that stretches over 150 years, as the retirement group has been in business for over 30 years. We have offices all across the country, and we have an intimate knowledge of the 401ks and pension plans and retirement benefits for most of the Fortune 100 companies. And so this is where this gives us an edge to be able to help you specifically in transition on the best timing for your pension, for example, from specific companies that may have an advantage to consider retiring in one quarter versus another quarter because of what interest rates are doing to their pension plan. So if you hadn't already done so, as I mentioned, you can take advantage of this complimentary cash flow analysis that we offer. And a way to reach out to us in an effort to do that is you can email us at info@theretirementgroup.com. You can call us at 800-900-5867. You can take a picture of the QR code to the left, and it would get you access to a calendar where you can schedule a 15 to 30-minute call with one of myself or my team members in an effort to answer some specific questions that you may have that's correlated to your personal situation. And we're delighted to set aside some time to do that. And if you hadn't already done so, you should take a picture of this QR code to the right, because it gives you access to our LinkedIn page, where we have some company-specific things for the companies that you may work for that might be relevant for you to pay attention to or to follow along with. And so we update that on a regular basis, and I'd encourage you to follow us on LinkedIn. So with that, what I would do is just remind you that the benefit of taking some time away from us is to produce something that's relevant to you, right? So if you haven't had a retirement plan or a financial plan done, reach out to us because we're delighted to spend some time with you if you're delighted or willing to spend some time with us. And so what I'll do is before we wrap up this afternoon, I'll pass it back to Sam to see if we have any questions, and then we'll let you go for the afternoon. Sam?
Hey, Patrick. Yes, let's answer just a couple questions. I don't want to keep anyone too much longer. This first question: how do election cycles influence the stability and performance of the stock market? And what can retirees do to mitigate potential risks during these periods?
Yeah, so this is a great question. And the short answer is you need to have a plan. Okay. We can go back at any point in time in history and earmark or talk about things that could potentially have affected us negatively, right? And so if you're looking for a reason to make an adjustment in your portfolio, it should be correlated to what I mentioned during the presentation today, which is that you've had a change in your tolerance for risk or your financial goals or your investment objectives or your time horizon, as opposed to saying the reason we should make an adjustment in our portfolio is because we have a tax year or an election coming up. And historically, that means that if this party gets in, that these changes are going to occur, or this party gets in, these changes are going to occur. Because typically the move is to do nothing, and that's because things haven't changed for most of the folks that we advise, even though there's an election year coming up, or even though COVID happened, or even though there's things going on overseas that we don't like to see in Ukraine and in Russia and Iran and et cetera. These are all reasons that you could make up to say, I think we should make an adjustment to the portfolio, when in reality, it might be best to just stay the course because nothing in detail has changed in your overall objectives or goals or tolerance for risk or any of those things. So I hope that helped.
Alrighty, thank you. Alrighty, number two. How can I approach diversification in my portfolio, considering the possible shifts in economic and fiscal policies after an election?
Yeah, again, have a plan.
Yeah.
Have a plan. I think it's we got to be really careful about all of a sudden impacting the portfolio, like I said, because certain things have already transpired, right? Like we get a certain president that maybe you're uncomfortable with. So here's the thing. We can always find a way, as I just mentioned, as to why we should do something different to the portfolio, right? But what we should be thinking about is, as I mentioned, if the grand scheme of all of the things that occur or give us a base to work from, which is how we generated the financial plan to begin with, and we work from there. If a certain party gets in and we know that something's going to change, like for example, the tax code, then we can start talking about specifics, saying, okay, maybe there's some tax planning that we can do inside the portfolio, which makes sense to sell or trade this, or this to move over here for whatever reason, because it's more tax efficient for you or it's more advantageous from a tax perspective. That could be an example of why you would want to potentially consider an answer to this question as to what happens after an election and what could potentially change, because we know the tax code's changing, because based on who's in office, they're going to change the tax code. And in doing so, it may mean we could have some planning aspects that are beneficial to you that might make or might have a reason for us to make an adjustment for sure. So I hope that helps.
Alrighty, Patrick. We're just going to answer one more.
Okay.
After this webinar, you will be redirected to our retirement page homepage, so you can book an appointment with either Patrick himself or one of his colleagues if you'd like to have anything discussed further or more specific situation discussed. So please take advantage of that. Alrighty, Patrick, last question. In periods of escalating inflation, what underlying reasons cause value stocks to outperform growth equities?
Yeah, great question. In an environment where the interest rates are going up, oftentimes that puts pressure on the growth side,
Mhm.
specifically because they're leveraging money from the banking system or from a financial system of some sort. In other words, if the interest rates go up, they get more pressure to have to pay more for the funds that they need to create inventory to be able to sell more of the products that they sell. So if the interest rates are going up and it puts pressure on these growth related companies, it just has the impact of them having to put more capital to work that could be used in other places. And it makes this is part of the reasons why it makes those companies potentially expensive to buy. And so therefore, if you look at the other side of the fence, it makes value stocks often inexpensive. And so that's one of the primary reasons. And so because they have, as I mentioned, low price to books ratios and low price to earnings ratios and things that would value a company at a number higher than what you're technically paying for, it produces a margin of safety for you, which is often beneficial when you're already in retirement for sure, and you're, in addition to that, you're pulling income from your portfolios. It just makes for a little less bumpy ride for sure in many cases. And so, yeah, I hope that helped.
Alrighty, Patrick, that was all we had time for. Anything else before we end?
No, I think that covered it. I hope you found some
Alrighty.
value in spending some time with us today.
Yes.
And until next time, we'll see you.
Thank you, everybody. Thank you, Patrick. Have
Take
a
care.
great day, everyone.